Hey there, and welcome. Today, we are going to pull back the curtain on the language of business, accounting. Now, I know it can seem a little intimidating, but I promise you, by the end of this, you're going to have the tools to understand and record pretty much any financial transaction. So let's jump right in. What if I told you that all of accounting, from a tiny coffee shop to a giant tech company, really just boils down to a few core rules? This isn't about being a math whiz, not at all. It's about learning a new language, and today you're going to get fluent. So here's our game plan for today. We'll start with the 2 unbreakable rules of accounting. Then we'll meet the 5 main characters you'll find in every financial story. After that, I'll show you a super simple 3-step method to handle any transaction. We'll see it in action with some examples, and we'll finish up with a cheat sheet you can use anytime you want. All right, first things first, we have to talk about the foundation. Everything, and I mean everything we do in accounting, is built on this really simple but powerful idea of balance. Once you get this, the rest just falls right into place. So what even is a journal entry? Well, think of it like the very first sentence written in a company's financial diary. It's just a simple, standard way to log every single transaction. It captures the who, the what, and the how much. It is always step 1. And here we have golden rule number 1, the famous accounting equation. All this really means is that everything a company owns, that's its assets, has to equal everything it owes to other people, those are liabilities, plus what the owners themselves have put in, that's the equity. This equation has to balance. Always. No exceptions. It's a law. And this leads us right to golden rule number 2. For every single transaction, the grand total of the debits has to equal the grand total of the credits. This is the absolute heart of what we call double entry accounting. You can think of it like the law of gravity for finance. For every action, there's an equal and opposite reaction. Okay, now that we have the rules of the game, let's meet the players. These are the main characters of our financial story. Just about every transaction you'll ever see involves some combination of these 5 account types. Okay, stop and take a good look at this slide. Seriously, this table has pretty much everything you need to memorize. That's it, and you'll start to see a pattern here, right? Assets and expenses, they act the same way. They both increase with a debit. And then you've got liabilities, equity, and revenue. They're the opposite. They all increase with a credit. This table right here is your key to everything. All right, so we've got the rules, we've met the characters. So how do we actually put this all together? Well, lucky for us, there's a simple, totally foolproof method that works every single time. Let's break it down. Here it is, just 3 little steps. First, you just ask yourself, okay, what 2 things changed here? Second, for each of those things, you ask, did it go up or did it go down? And third, you just apply the rules from that table we just looked at. That's it. This process completely takes the guesswork out of it. Okay, enough with the theory. The best way to actually learn this stuff is to just do it. So let's run through a few really common business transactions and put our 3-step method to the test. All right, first one up, a business gets a loan. Pretty standard stuff. So money's coming in the door, but at the same time, the business now owes that money back. Let's break it down using our method. Let's apply our method. Step 1, what are the accounts? Well, we've got cash and something called notes payable, which is just the formal name for a loan. Step 2, did they go up or down? Our cash, which is an asset, definitely went up, and our loan, which is a liability, also went up. So step 3, we go back to our rules. To increase an asset, we debit it. To increase a liability, we credit it. See? Simple as that. And here's what the final result looks like. We debit cash for $5,000, and we credit notes payable for $5,000. Notice, the debits equal the credits, the transaction is perfectly balanced and perfectly recorded. Okay, next example. This time, the business is basically trading one thing it owns for another. It's buying a piece of equipment, which is a long-term asset, by using cash, which is a short-term asset. Let's run the play again. Step 1, the accounts are equipment and cash. Hey, they're both assets. Step 2, the equipment account is increasing. We have more equipment now. But our cash account is decreasing. We have less cash. So, step 3, we look at our rules. An increase to an asset is a debit, so we debit equipment. And a decrease to an asset is a credit, so we credit cash. And there's the finished entry. Debit equipment, $3,000. Credit cash, $3,000. Once again, it's perfectly balanced. all we've really done here is swap one asset for another on the company's books. Okay, one last example, and this one happens all the time. The business did the work, it earned the money, but the client hasn't actually paid them yet. So how in the world do we record that? You know the drill by now. Let's run through the steps one last time. Step 1, the accounts here are service revenue and something called accounts receivable. Accounts receivable is just an asset that represents money that's owed to us. Step 2, our revenue has increased because we earned it, and our accounts receivable asset has also increased. Step 3, to increase revenue, we credit it, and to increase an asset, we debit it. And there it is. We debit accounts receivable and we credit service revenue. Now here's the really crucial part. Our records now show that we have earned that money, even though the cash is not physically in the bank yet. This is a perfect example of what accountants call accrual accounting. Phew, we've covered the rules, we've seen them in action, so now let's just put it all together into one final powerful takeaway slide that you can use as your go-to guide. Here it is again. This one little table, combined with that 3-step method, is honestly all you need to tackle almost any basic accounting transaction. Just remember, assets and expenses go up with debits. Liabilities, equity, and revenue go up with credits. I'm serious. Go ahead and screenshot this. It's your ultimate cheat sheet. So what we've seen today is that journal entries aren't really just about numbers and rules. They're about telling a story. Every single debit and credit is like a word in the ongoing narrative of a business. So now that you understand the basic grammar and the vocabulary, what story is your money or your business's money trying to tell you?